Hello, friends. Welcome to Nirmal Bang. I am Piyush Jain, and today we are going to be taking a top view on the markets. We are going to be discussing about the Indian markets, global markets, and we are bringing a guest who is an industry veteran, a guest who has seen the global markets, the Indian markets, emerging markets very closely. Let me introduce Mr. Geoffrey Dennis. He's an independent emerging markets commentator and an expert who is widely recognized across the globe. Mr. Jeffrey, welcome to the show.
Thank you very much.
So let's start from our perspective of how you're reading the overall equity markets at present. And I'm asking you from the perspective of existing liquidity, from the perspective of continued Russia-Ukraine war, which is having a slightly tiring effect on commodities, also on everybody. But it is also inducing higher inflation, and we are seeing this is causing very divergent growth trends. I was looking at the PMI numbers for Europe showing very sort of high slowdown. I was looking at the macro numbers of US, job numbers decent. Then we were looking at the other data, housing again that was robust. India numbers are good, but other Asian numbers were showing slightly slowdown. It's a very divergent trend right now happening across the globe. So how do you read the equity trends?
Yes, you're right. It's a very divergent growth trend. I mean, clearly, markets and economies seem to have got over the initial shock of the Russian invasion of Ukraine, and now we're looking at the longer-term macro effect of that. And as you say, there's quite divergent. There's not much more I can add to what you're saying. Europe does look quite weak, although, as far as I'm concerned, the underlying growth rate of Europe, the euro area, and indeed the UK is slower than the US anyway, and yet, and with that in mind, also the US has been a major surprise. I was reminded this morning in an article I was reading that just a few months ago the Fed was expecting 1% growth of GDP in 2023, and now looks like it might be north of 2.5% of something of that order. So big surprise in the US. And of course, across the rest of the world, Asia is generally doing well. But one reason why we had a big market pullback in August was because the Chinese data has been very disappointing. And so even hitting that 5% growth target in China, which the government has, may be rather tricky. Now, you mentioned liquidity at the beginning of your question. There is no doubt that this big rise in short-term and more recently long-term interest rates has squeezed liquidity in a number of countries, in fact, across the globe. And we've yet to see that come through. But I'm confident that inflation is on the downtrend. And now, if it's true that the US will avoid recession, I think that's a very important support for the equity markets long term.
Right, and does that imply that actually we are now in a position to say that perhaps U.S. economy is going to stay strong in the second half of the year? We are saying that yes, the inflation is tapering down away from the long-term target, but still basically it's looking okay from the equity markets perspective. Like how are we reading the U.S. markets?
I think that's correct. I mean, we did have a major pullback in the US, indeed in global markets until a few days ago. The US was down about 5% in August. Emerging markets were down 8%. In fact, it actually fell 8 days in a row until earlier this week. Now, there were two reasons for that. One was the very, very poor Chinese data, which we're still trying to wrap our arms around as to how weak the Chinese economy is. But also, you've suddenly had this major surge in US long-term interest rates, which has got a lot to do with uncertainty over how much more in the way of interest rate hikes, if any, there might be from the Fed, and of course, great uncertainty, which I've always argued was the case. The great uncertainty over when the first rate cut will be, and I don't think that's going to be for a very long time, as far as I'm concerned. Now, what makes me comfortable about the markets at this level and why I would be a buyer is we are very close to the peak of US interest rates, if not already at the peak. Inflation is at 3% plus. I don't think it's going to come down any more year over year over the rest of this year, but it will come down more in the first half of 2024. So we are heading towards that 2% target. And that means the tightening cycle is pretty much over or very close to over. Meanwhile, as your viewers will know well, the earnings story in the US has held up very well. So I think if this narrative is correct, I think you have to be a cautious buyer of US equities, and I think that will support equities around the world as well.
I think our viewers will take that point with a lot of optimism. And I'm also actually now curious to ask you, um, are you expecting any sort of rate cut in the sort of last quarter of this year, or maybe the rate cut is going to happen next year? Because 3 months back, I know the market expectations were of a couple of rate cuts in the second half of this year. Like how you're looking at it?
Well, that was never my expectation, and I never could see the argument for rate cuts late this year, unless we went into a full-fledged recession, and so far that doesn't look very likely. There are two reasons why rates could be cut in the next, let's say, excuse me, 9 to 12 months. One would be the US economy falls into recession. Now, I still think that's a possibility. I don't model the economy aggressively, so it's hard for me to make that formal call. But if there is going to be a downturn in the US economy, it's going to be very mild, and it's not going to be probably until, at the very earliest, the first half of 2024.
But you still see that that could be a possibility.
I think it's a possibility. I wouldn't give it a very high possibility, but I think it's a much greater possibility that we will not get a downturn, frankly, in the US economy. I'm just throwing it out there as a small possibility. The other argument for lower rates, which I think is a more powerful one, is as inflation moves down towards 2% in the early part of 2024, real interest rates, both long-term and short-term, will go up, and that will squeeze the economy as well. Now, having said all of that, I don't see a rate cut out of the Fed until the second half of 2024 at the very earliest, because without a recession and with the economy doing reasonably well, assuming that carries on, I don't see why the Fed would cut rates. They would wait until the economy needed help, and then they would have plenty of ammunition with interest rates around 5.5 to cut rates to provide support for the economy. So I see no prospect of interest rate cuts for several months ahead, probably not until the second half of 2024 at the earliest.
Right, and that also actually then makes me ask you, from that perspective, when you have this sort of landscape, no interest rate cuts, but inflation gradually coming down, largely economic data is looking reassuring. Earnings you were just alluding to, that actually was looking okay. From that perspective, now basically in US markets, which sectors actually would you be actually sort of buying into?
Well, if we are now at the peak of interest rates, at least very close to the peak, and I also believe we are close to the peak of long-term interest rates, 10-year yields around 4.3, 4.4. I think you have to tiptoe carefully back into the technology sector, which of course did so well earlier this year. In other words, I think where we should be here is more in the growth sectors, assuming that interest rates are at their peak. So good examples of technology, good examples would be healthcare, some of the consumer sectors. I think that the cyclical sectors, materials and energy, are a little bit more risky because of uncertainty about the global economy, in particular in light of the Russia-Ukraine war and the worries about China. So I would tend to stick more to the growth sectors, which benefit from a peak in interest rates coming. At the same time, I think banks will probably do quite well because you now built up some nice margins for them to make money on their deposits they've got. Although there is a lot of talk in this country of more regulation coming down the pike for the banking system, and that would be a modest negative. So, I don't spend a lot of time talking about individual sectors in the US, but that would be the sort of structure of a portfolio I would have.
Well, I'll now take this point towards the emerging markets on which you command such a sort of nice, almost master, I would say, or you have such a deep knowledge about it. When we talk about emerging markets, does that sort of sectoral preference moves towards the emerging markets also? How do you see the emerging markets now?
Yeah, I think it's a little different. Well, I think broadly it would be the same in emerging markets, but I think there are differences in EM that we have to be aware of. First of all, the one part of the EM story, or the two parts actually of the EM story that are really not helping this year are, first of all, China itself. I mean, China is down, and I'm quoting MSCI data here, and I've just updated the data this morning. MSCI China is down 7% this year. EM is up about 3% this morning, got very close to the zero line a few days ago. And yet a month ago, EM was up 10%. So we've had a big fat correction here. But what's interesting is if you strip out China from EM and you strip out the US from DM, US being a big outperformer, China being a big underperformer, both asset classes are up about 6.5 to 7% this year. So China's been a big drag on the US and frankly on EM, I'm sorry. And frankly, I don't see that ending at this point because there's going to be a lot of uncertainty about the Chinese economy going forward. And as you all know well, in particular, grave concerns about the Chinese property sector. Now, the other thing that's not going correctly as far as I'm concerned for EM is the dollar's strong again. It's gone from 111, 112 against the euro to 108. And without the weaker dollar, there's not a great incentive for investors to put money to work outside the US. And so I think the EM is going to rally from here, but it's going to rally tentatively. And I think it's probably going to underperform DM over taking 2023 as a whole. Now, let me talk more about countries, if you wouldn't mind. I think Latin America looks great and it's done well this year. And that's primarily because they were one of the first areas of the world to raise interest rates, and now we're starting to see those rate cuts. Emerging Europe looks good, and India does look good as well, as far as I'm concerned. It's up nearly 6% in dollar terms this year. It's underperforming EM ex China, but it's outperforming EM overall, and I think it's now basically going to soon become the most important story in EM as China struggles dramatically, although, of course, China's weight in the index is much higher. And the one thing I think you have to worry about in India, there's the usual concern, of course, about valuations, but the one thing you've got to be concerned about is that jump in inflation you had last month, which means that there's some uncertainty about where interest rates could go. Could they still go higher from here? Once you get over that, I think you'll find that India does look pretty good, and I would definitely be overweight India at this stage of the game.
Absolutely. I think the vagaries of monsoon, I think, was causing the inflation spike in another month, and perhaps the inflation will look better. Mm-hmm. Yes, but staying with the India story here, at present, how is sort of India stacking up on a valuation matrix basis versus growth? On one side, you have an India story which has been outperforming, as you were just highlighting. On the other side, valuation. So how basically you are looking at it?
I mean, I think the issue with India is always people say, oh, I'm a little wary about India because valuations are high, but then they're always high. And it's partly because of the structure of the market. You don't have a lot of cyclical stocks in India. Well, you do, but you just don't have a big weight in the cyclical stocks.
Absolutely.
You've got a lot of technology, a lot of pharma, a lot of banking, a lot of banks, that's right, healthcare, etc., some consumer. And so I think you have to kind of live with the valuations to a certain extent. I think there's a great level of interest from foreign investors, net over the long term in the Indian story. And I think all that's happening here at the moment is with the spike in inflation, albeit, as you say, it was driven by the monsoon, perhaps, and food prices, as I said when you were talking, forgive me. People will want to see that's only a spike and they'll come down again. Because if they don't come down again, well, then you'll see the risk of higher interest rates, and that's going to put some of the big growth sectors in India under fresh pressure. But to me, you have a long-term structural overweight in India, probably in the growth sectors as well, because this is now the story, as far as I'm concerned, in the emerging market world. It is, as you know well, it's got the highest population in the world. It's now the second biggest emerging market within the EM index, which I don't see a lot of people talking about. It's bigger than Taiwan. It's bigger than Korea. And as China struggles with tremendous problems of population growth and pension overhangs and real estate overhangs and consumers that don't want to spend, I think India is going to do very, very well, not least because, if I may say so, the low base that it's coming from with very, very low GDP per head. So there's tremendous upside potential in India. And I think it's fair to say that foreign investors always want India to succeed. And I think unless there's some major shocks down the road, like a big inflation spike or a massive increase in the budget deficit or a huge increase in oil prices, which puts inflation under pressure again, I think India will do very well here. And I would again tend to focus my investments more on the growth sectors.
Right, and those growth sectors, again, as you were just highlighting, remain the BFSI, technology,
Yes.
manufacturing also. How do you see the manufacturing part here?
Well, I agree. I think manufacturing does pretty well. Now, of course, you've got the issue of are they selling at home? Are they selling overseas? And I think a lot of this stuff is being sold at home into a fairly buoyant economy, which I think is appropriate. I mean, clearly, it's not for this venue. I guess it's a big long-term discussion point. But will India ever get to the sort of manufacturing economy that China became over the last 20 years? I kind of doubt it. But there's so much more money and investment that could go into the manufacturing sector that if the policies are right, and that means low interest rates and low tax rates and simpler tax rates, etc., I think the manufacturing sector long term can do well. Whether it's going to be an outperforming sector at the moment is more difficult to call. I would go more, as I say, for the more traditional growth sectors, particularly for technology, to do a little bit better than it's been doing recently.
Right. One small question, Mr. Jeffrey, I wanted to ask you, like, we have seen the long-term funds, whether they are pension funds, sovereign funds, the very long-term funds, they basically are deploying money in a very stable manner in Indian markets. Of late, we have seen the ETFs or the hedge funds, they basically have been worrying too much about the currency impact, possibly, like from the context of dollar, which you were highlighting. From that point of view, do you foresee any sort of major risk to the emerging market currencies versus the US dollar over the next 5 6 months?
No, I really don't, for two reasons. First of all, I do tend to believe that if US interest rates are near their peak and if bond yields in the US are near their peak, even if the economy stays on the strong side or stronger than expected, I do think the dollar, which is overvalued in my mind, is more likely to go down than up. In other words, if you ask me where the next 5%, 10% move in the dollar's coming, more likely to be down than up. Well, let's see if that plays out. Now, and within that, of course, and India was perhaps a little slow to this game, but in a lot of emerging markets, you saw much earlier rate hikes than in the US. Brazil, for example, raised rates for the first time in February 2021, way before anybody else. Now they're cutting rates. So there's a big interest rate gap versus inflation and versus the US in many EM countries to support these currencies. And so I think if monetary policy continues to be prudent, rates coming down in some of these countries that have raised rates a lot, but are coming down slowly and prudently. And the RBI in India deals with the inflation spike short term carefully without, cutting interest rates aggressively, waits to see what the trend is before they think about rate cuts. I see no reason why currencies need to be a major problem for EM going forward. Bear in mind also, if you do a long-term chart, 6 to 12-month chart of the Indian rupee, it hasn't behaved badly at all.
Yes.
It's not been particularly stable, but it isn't really going anywhere. And so short of there being a big surge in the dollar from here, which frankly I don't see, unless of course the euro is very, very weak, I don't see a big surge in the dollar. And without that, I don't think currencies are going to be a major negative for emerging markets, and that includes India.
Well, so overall, as per our conversation, equities, they remain look attractive. Inflation perhaps continue to taper down. We are looking at a good high confidence both for the US markets and the emerging markets. Perhaps my last question would be, though we know you for your equity comments, but I wanted to ask you regarding precious metals, in particular gold, which again basically is viewed as an investment class here. Is that something which you think the outperformance has been already done, and now basically there is no sort of major sort of outperformance from here?
I think it's done, yes, and it got an extra lift, of course, because of the quote-unquote banking crisis that we had earlier in the US in March and April, when 3 or 4 smaller banks went bust, and there was concern about the banking system overall. Obviously, if there's a return to that, and these are challenging times to a certain extent for smaller banks, not for big banks, I don't think. So if that were to rear its head again, and Moody's did downgrade some smaller US banks again a few days ago, that would be one reason to buy gold. But the major reason you'd buy gold here is if you thought the inflation problem was not going to go away. And I've always argued that 9.1% for US inflation last fall was the peak. I always thought we'd be down to around 3% by the middle of the year, and that was pretty clear from the numbers. You just had to run a model. It was quite simple. And it's also pretty clear for me we're not going any lower than 3% over the rest of this year. But assuming we head eventually down towards 2%, European inflation comes down, China's in deflation, EM inflation is probably coming down in most countries as well. I don't think gold is a big fundamental investment at this stage, as far as I'm concerned.
Very clear comment on what actually perhaps is actually going to look good. And sitting here in emerging markets, our viewers would have taken note of all of that, and also actually would have gained more optimism about the Indian markets. Mr. Geoffrey, as always, it was a pleasure having you on the show, and we are grateful that you once again basically came on our show. And we're looking forward to have you again sometime in the future.
Yep, good. Thank you very much.
And dear viewers, with that, it's a wrap on the show. Hope you liked it.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.